Welcome to HCM's fourth quarter market update. My name is Doug Johnson. I'm the senior investment strategist here at HCM. And today we wanted to provide an update to our current market thinking, as well as how that may be affecting our portfolio positioning. So just as a quick reminder, we do have a shorter version of this presentation that will be available. Think of it almost as an executive summary of sorts, but this one will include the one we're currently doing, will include additional charts and information, and just in general go into more detail about what we see going on in the marketplace. So to start off, let's take a look at kind of our high-level thinking. On the stock side, our equity positioning remains at neutral target, basically meaning that we don't have an overweight or underweight to equities right now, which subsequently means we don't have an overweight or underweight to fixed income. Every model that we have is set at neutral positioning, but we do have an emphasis on higher quality, large cap securities in our equity portfolios. The reduction in rates by the Federal Reserve has certainly helped support equity prices, though we'll probably need more accommodative policy before we can regain or surpass the all-time highs that we saw this year. Just last week, there was an announcement from the Fed that was considered to be a quantitative easing light, so to speak. That may be a step in the right direction, but it's probably not the type of policy announcement that we would expect to drive equities significantly higher. But again, it was certainly a step in the right direction. From a sector standpoint, we continue to see defensive sectors outperform, which could indicate, a concern around economic growth and forecasts. Outside of the IT sector, what you're seeing is real estate, utilities, and consumer staples as the next three highest performers. So, historically, in a market expansion, when we're in a phase of aggressive growth, those sectors would not be the ones to be leading the way, so to speak. Tariff issues and a strong dollar have continued to provide headwinds for international assets, both developed and emerging markets, and we remain underweight international in all our portfolios relative to the U.S. We did see some tariff news last week of a pseudo phase one type deal. There was a lot of different wording to describe it. At the end of the day, we've told clients this, and we continue to believe that until a comprehensive deal is signed, that no deal has been reached. We can have these agreements on certain aspects of it, but until we see something that is comprehensive, includes intellectual property theft, and anything along those lines, it's probably just more bluster than anything else. But on Friday of last week, we did see a positive market reaction to optimism around a deal, but that was walked back somewhat early on Monday morning. So again, a comprehensive deal remains elusive, and will continue to challenge international assets going forward. On the fixed income side, our portfolio duration, we went ahead and increased that back up as growth forecasts and economic data continue to deteriorate. As a reminder, portfolio duration is just a way of describing the relationship between interest rate movements and bond price movements. So if rates go up, bond prices go down, and vice versa. The higher your duration is, the more price sensitivity you have. So rewind back to 2018, when the forecast was for rates to continue to go up. Even into 2019, we had added more short duration positions into the portfolio to counteract that movement. As rates have begun to come back down, we've taken out our short duration positions piece by piece by piece, but now we feel like we're at the point where the conditions are present for us to go ahead and just remove the remainder of our short duration positioning. That reduction in short-term rates from the Fed that we talked about has lowered income levels for money markets and short duration bonds. So part of the reason why we made that decision was the lowered current income, and also the lowered expected income that we're seeing from cash-like and short-duration positions. And lastly, index performance year to date has been driven mainly by that drop in rates. So the bond index is up close to 8% this year, mainly on the heels of rates dropping significantly from a high of the 10-year at 3.25% in October of last year, all the way down to a low of, I think, 1.45 a few weeks ago. On the economic front, global growth forecasts remain hampered by surrounding uncertainty with the tariffs. As those have remained in place and that rhetoric has gone back and forth, there remains a kind of a freeze in the global supply chain, so to speak, and that's slowly working its way through economic forecasts and really at the corporate level too, as we'll see in a few slides, the effect that it's having on earnings. Recession concerns remain in the U.S. We saw a brief yield curve inversion for 4 or 5 days several months ago. That inversion has since been undone, and we're back with a positive yield spread. We've also seen manufacturing output drop below key levels, which we'll look at here in a few slides as well. Inflation really remains a non-issue right now and below the Fed target of 2%. Lastly, we've had some questions come up about the presidential election and how that's going to affect markets. We think those political issues will come into focus, but we just don't think it's the time quite yet. Once we know who the Democratic candidate is going to be, whether it's going to be Bernie Sanders, Elizabeth Warren, Hillary Clinton, that all remains to be hashed out. And until we get clarity on who the exact candidate is going to be and what their platform is going to look like, it's hard to tell exactly how that's going to affect markets. But it's certainly something we have our eye on. We just think it's a few months off. So what are the risks going forward? We think 3 main risk themes are present. The first being slowing economic growth in the U.S., accelerating into a recession, any escalation of negative rhetoric in the U.S.-China trade negotiations, and then lastly, any unexpected message from the Federal Reserve in the direction of future policy, mainly if the Fed were to come out and give any inclination that they were hawkish, and by hawkish we mean looking to raise rates or tighten monetary policy. So those are the 3 risk themes that we see moving forward. At the same time, if those things are overcome, that could also be a catalyst to drive markets higher. So let's go ahead and move into the more detailed portion of the presentation. So the chart on the screen now shows the return for the S&P 500 in orange, and then the U.S. bond index in blue. And what we would like to point out in this chart is that while equity returns have been very strong year to date, market returning close to 18.5% as of October 1st, almost all of that return happened in the first 4 months of the year. So you had the low from the large sell-off at the end of last year, creating a kind of a jumping off point, so to speak. Rewind back to the beginning of this year, you had the Fed kind of changing their stance in terms of monetary policy. They weren't going to raise rates anymore. They might cut rates. All of these things kind of caused the market to do a 180, and you got this huge rally up until about May 1st. And you can see that line, that May 19 line, if you take that all the way horizontally over to the end of the graph, you can see that the market really hasn't done much. It's kind of gone up and down, but essentially has gone sideways since then. If you remember back, the beginning of May was also the introduction of the threat of tariffs with Mexico, which kind of came and went pretty quickly, but it got investors' attention to the idea that this tariff issue was serious, and it could snowball into something greater than just China. And also, since then, we've had increased negative rhetoric with the Chinese. Absent whatever was hashed out last week. But that's caused a lot of this sideways movement. Subsequently, you take a look at the blue line, and a lot of the 8.5% return that we've seen out of the bond market has actually been generated since that time frame. That time frame being from May 1st until now. So as the introduction of a little bit of equity volatility came in, you had an acceleration of rates to the downside, and subsequently driving bond returns up significantly this year. So pretty much if owning equity or fixed income assets this year has been pretty lucrative. We wouldn't expect these returns to happen every year, but we'll certainly take what we've got right now and be happy with it. As I mentioned earlier, regarding the kind of freezing up of the global supply chain and how that's affecting corporations, this chart shows the number of S&P 500 companies that have provided either positive or negative earnings guidance in a specific sector. So what you'll notice is there's a lot more, the red bars are more prominent than the green bars, meaning that there's been more companies actually providing negative guidance in their earnings forecasts. The information technology sector being the most prevalent, or most prominent, should I say, with 29, which I believe is close to an all-time high for that sector. But after that, you have consumer discretionary, healthcare, industrials, materials. Those sectors, all five of those sectors have historically been considered growth or growthier sectors. And with the growthier sectors, what you're seeing is that the high-flying names of the past few years are starting to run into some headwinds. And when we start to see a collection of negative guidance from corporations, it should raise some red flags that not all is well, and it could cause certainly some issues going forward if the tariff situation isn't resolved sooner rather than later. Now, again, this could just be corporations lowering the bar for themselves, but this is certainly a trend that you would not want to see continue going forward. We mentioned manufacturing. This chart shows the ISM manufacturing index, which has been pretty, I don't want to say accurate because I don't think accurate is the word, but it's a closely watched report in terms of the health of the economy. Now, ISM puts out both a manufacturing and a services index. This is just focusing on manufacturing. And the reason we've only included this one is because since the beginning of 2018, you've seen both of these lines, the blue being represented with new export orders, and then the red, which is kind of just the total composite index itself, has been trending down in a significant way. So we saw a reading under 50 for the red line for the first time in quite a while. And 50 is kind of that line in the sand where anything above that is considered expansionary, but anything below that is considered contraction. So this isn't necessarily a recession call, but as we see more of these hard data points on an economic front start to pop up, it certainly grabs your attention and makes you seek out, more factors that would lead you to believe that we're not going into recession. We've been adamant in our publications that we're not calling for a recession anytime soon, but the continuation of these data points certainly makes us a little bit more concerned about that forecast eventually needing to be revised. So not all is lost on the market front, so to speak. So this is a chart from one of our strategists, Ned Davis and Associates, and we've actually included this in a market insight that we put out, I want to say about a month ago. And what it shows is it shows equity returns for the Dow Jones Industrial Average before and after a second Fed rate cut. So that vertical line that you see is kind of the day of the second rate cut, so to speak. So the 12 months prior to that is pretty uneventful, just kind of sideways. But if you look after that, historically, there's been some pretty good returns after that second rate cut. The average return 6 months afterwards is about 12%. So that's historically that's an encouraging sign that, when the Fed is willing to cut rates, that it's been a good environment for equities. Now, there are some caveats to this, and mainly if the timing from the Fed is a little bit late on this, and recession's kind of the wheels of recession are already in motion, so to speak, then you're going to see negative returns regardless. The three time frames that we can point to with that kind of fit this, so to speak. You look at 1929, 2001, and 2007 as kind of the most negative examples. But in all of those time frames, even though the Fed cut, they were late, and the returns 12 months after when we saw the recession were negative, and in some instances pretty substantially. And we can all remember back to the Great Recession. And even after the Fed cut rates twice, the market was down 40% 12 months after that. So that's not to say that we're going to see a repeat of that. But I think the key here is that the Fed is doing what they feel like they need to do to be accommodative to the market. But a recession, if one were to occur, would probably negate their efforts and make them pretty fruitless, so to speak. So we've talked about rates a lot this year and how they relate to bond prices and bond price movements. I remember back to 2018, and we were having a lot of conversations with clients, and they were asking the question, why do we own fixed income? Rates were moving up, bond prices were going down, and people were seeing negative returns in their bond portions, and thought, why are we going through this process? Well, fast forward 12 months, and things change pretty quickly. What you'll see is that if you look at that 2018 vertical line and then go all the way over to now, about halfway through that is the October peak for rates. So you had, again, that blue line is the 10-year Treasury with a high yield of about 3.25%. The orange line, there's the 2-year Treasury. The red line all the way at the bottom is the spread between those two, and then that green line represents the 10-year inflation break-even rate, so kind of what the market is pricing in for inflation. But you can see very clearly that since that high rates have gone straight down, so to speak. I mean, we've got this is October 1st, where the 10-year was right around 1.7, and it's kind of still moving around those levels right now. You have the yield curve at about 5 basis points, and you've got inflation expectations at about 1.5%. So you can see how the drop in rates has caused a significant increase in bond prices this year. But as we move through the year, and if rates continue to move lower, that would be concerning, as it would signal that there is some concern about economic growth going forward. On the flip side, low rates have been a pretty good tailwind for equity assets. So we could certainly still see an environment where you have both equities and fixed income returns solid through the rest of the year, but there is the issue of at some point the law of diminishing returns kind of kicks in, and you can only squeeze lemonade out of a lemon, so to speak, for so long until you run out of juice. And I think there's a little concern that we may be kind of approaching that situation here coming up. But nonetheless, rates are low, and they've been trending lower for quite some time now. This is a look at the Fed funds rate. So this is the rate that the Fed directly controls. You can see that stair step up all the way to right around 2.4 from back in 2016 when they first raised rates. Now we've had 50 basis points worth of cuts in the last quarter, and we've gone from 2.4 down to 1.83. So this reduction in rates, it's going to start doing a few things. It's going to start lowering the yield available on cash instruments and short duration bonds. So for everybody who's enjoying those, 2.5% money market rates, those are probably going to start to go away. Now, we're still way above where we were when this whole rate cycle started, or the hiking started back in 2016. But as the projection for rate cuts continues, we certainly need to take a look, and investors need to take a look and consider and maybe reevaluate what their fixed income strategy is going to look like. As I mentioned earlier, we have taken our short duration positions off just because we feel like with the concern about growth going forward, and now the lowering of income from shorter duration cash-like investments, the benefit seems to be gone, so to speak, from that. The only way that we would be hurt by that is if we saw a quick, massive spike in rates, and we think outside of a comprehensive China deal with additional growth, we don't see that as a likely outcome. So finally, this is the return profile year to date of several asset classes that we own, actually. So what you'll see is that higher quality large cap stocks, have continued to drive equity performance this year, with the blue line at the top being the minimum volatility factor, generating the highest return at almost 23%. The green line, which is the S&P 500, right around 18.5, and then you've got small cap and international pretty much right on top of each other. So big discrepancy in returns for equities. At the end of the day, you look at that and you say, okay, they're all in double digits. So from an absolute basis, that's not bad. But you can see that, depending on what you own, it can make a big difference in your return profile. So just as a reminder, we've been underweight international equities in our portfolios now for several months, which has been beneficial. And just recently, we took our small cap positions out of our portfolios, and this would be represented by that red line, feeling that we would want to see a little bit more robust growth environment for us to feel comfortable owning small cap. So that's why we chose to remove those from portfolios. But nonetheless, we've maintained that high quality large cap bias for quite some time now, and we think outside of seeing that catalyst to change that, we're going to sit on that positioning for the time being. So in conclusion, we would say that there's really three themes to focus on throughout the remainder of the year: China, economic growth, and the Fed. So they're all interrelated in a way that a China deal would kickstart economic growth. However, at the same time, it may give the Fed reason to then stop their rate cutting cycle, so to speak, and you can start to see how all of these things kind of play together. On the flip side, if we see a continuation of tariff issues going on, we continue to see weak economic growth or deteriorating data points, the Fed will then be more likely to be accommodative and to continue to lower rates. So, the interplay of these three things is going to go a long way to see what the market is going to do for the rest of the year, and it's also going to be a big driver of how we condition or position portfolios for not only now, but for the next several months. So, again, until the China deal is actually signed and delivered, we would assume that there is not going to be a deal. And we're hopeful that there is one, but again, we've kind of seen this back and forth before. And it's a little bit frustrating to see, and it's really hard to manage around, so to speak. Now, if a deal is reached and it's a real deal, or somehow we see economic growth start to accelerate, then we would begin to take a look at adjusting our current portfolio positioning and adding back more things like small cap, adding more international, and even adding more value positions back into the portfolio. But until then, we're going to remain overweight quality. We're going to remain overweight large cap U.S. assets. So with that said, I'd just like to thank everybody for joining us today. I hope you found some value in the presentation. And as always, if you have any questions, comments, concerns, please feel free to reach out to myself or to your advisor, and we would be more than happy to hop on a call, shoot you an email, and make sure that that you get your questions answered. So again, thank you for joining us, and have a good day.